Hi everybody, welcome to our members only webinar, Track Record Trading Academy's members community members only webinar. We're going to talk today. We're going to talk about the state of the market and portfolio construction. And our guest speaker here today is Nick. I'll tell you more about Nick in a moment for those who don't know or don't remember who he is. But let's just begin with some housekeeping. So, disclaimer, our material used today is for educational purposes only. Views and opinions are not investment advice. Please seek professional investment advisors for that. That's their job. Ours is just to inform you about our views, and it's for educational purposes. So, okay, with that out of the way, housekeeping matters, you have a Q&A button on your interface of Zoom. Click that, ask questions at any juncture. We will address them as and when it fits. If not during the presentation, it will be at the end. This is a very casual presentation. It's a community members thing. So we are trying to build a community where we can exchange views and hear from experts such as Nick. Just click that. Comments, all are welcome. If you agree, disagree, anything, just put it in there. Let us know that you are not falling asleep. You are part of this whole process. We want you to be involved. So briefly, the state of the market as we know it right now, trade tariffs are now the norm. We started the year worrying for most parts of the year till the day that Trump announced those reciprocal tariffs. We were all worried about how it's going to turn out. It seems like it's now the norm. We have tariffs, pulling back of tariffs, retractment of tariffs. Even now, Japan thinks they have 15% tariffs, but effectively they are paying 27.5% tariffs. They are hoping for a refund. Nobody's telling them there is a refund, but that's how it goes. The market's pricing in for a refund, but Trump has not said anything about that. So this is the norm. If at the beginning of the year we said that this will be the norm, you would think that the markets will be much, much lower, companies will be worried and all, but it seems that Trump has the pulse of the market. He gives them the worst news first and then gives them slightly bad news. Then people are all happy because it's not as bad as they think. But this is how you boil a frog, I guess. You threaten him with a roast pit and then you boil him slowly. The frog is very happy, right? He doesn't die immediately. He dies in a slow death. I'm not saying that the markets will die, but the tariffs are much higher than what it was before, and yet the markets are very close to all-time highs. But this is the norm now. Geopolitical risk has lessened, but it is ever present. We saw wars in the Middle East, almost full, all blown out war, all-out war, and continues still. But it's now also the new normal. It's not as bad as it was, not as bad as it could have been. And the markets are happy with that. The Ukraine war is supposed to be a 2-week war, 3-week war, 2-month war, 3 months war, 6 months war, 1 year war. It's like 3.5 years later, it's still there, but the markets are used to it. And now they're talking about possibly a ceasefire or even a peace or a truce, whatever they decide. It is still yet unknown, but the markets are still happy with that because it's not as bad as it seems. We had a brief, harrowing few days where the Ukraine was given approvals to shoot missiles into Russian territory, but yet we are still here. Markets are close to all-time highs, so we are getting used to that. This is interesting, right? Because if we told anyone that there would be all these tariffs, there would be all these wars, and the Ukraine and European Union and US will be pushing Putin to the brink, we would have thought that this would be a bear market, but yet it is a bull market that continues to climb the wall of worries. The Fed has resisted calls, resisted ravings and rantings from the president to cut interest rates, but now they are more open to interest rate cuts. So this is the state of the market now. Rate cuts are likely to resume in September, and that's making, I guess, the markets happy for now. And the other thing that is very interesting to me is that the credibility and independence of the Federal Reserve is now at risk. if at the beginning of the year I told you this, that it would be at risk, that Trump would be trying to shape the Federal Reserve Board in the form that he wants them to be, which is like very open to cutting interest rates, it would have been a disaster for markets. But yet markets are very sanguine about the fact that he has threatened to sack Powell. We had a brief moment of a few hours, less than a day of panic that he would sack Powell. He walked back from that, and then now he has sacked Federal Reserve Governor Lisa Cook, and she's threatened, not yet executed, but threatened to use legal action to stay the sacking. Yet the markets are very sanguine about that, and basically I guess he did stack the Supreme Court to his side of the opinion, right? And he's going to try to do that with the Fed. If again, I told you at the beginning of this year, all these things will happen, you would have said markets will be at least 50% lower, if not more, but yet we are close to all-time highs. So what does this mean? I think this means this, of course, is very obvious if I say this now it's a bull market. Yes, it is a bull market, but it is a bull market when it climbed, which we always say this, it's climbing the wall of worry. There's a lot of things to worry about: tariffs, geopolitical risk, Fed independence, Fed credibility, Trump seeking legal action against anybody that he doesn't seem to like or seem to have wronged him in some way when he was not president, and yet here we are at a bull market. So, but more importantly, it is not heroic feat to make money in a bull market because everything goes up. But in spite of a bull market, we still want to build a portfolio that is resistant to both resistant to volatility, hopefully randomness, and also not susceptible to big underperformance during a bear market or a retracement. So I will let Nick tell you more about his philosophy. Nick, I first came into contact with Nick. He was the first person to sign up for a track record trading boot camp. Right, he turned out very keen. The time he was very young. He's still very young still, but he was much younger then. It was in 2016, and he took the 2-day boot camp. He worked for track record after he graduated. Worked for a few years, and then he graduated to much bigger things. At one stage, he was one of the biggest miners of Bitcoin in this side of the world, I believe, outside of big corporations. It's probably one of the biggest individual miners of Bitcoin. He did tremendous feats of amazing feats in the Bitcoin mining industry. And now he manages his own portfolio under Trident Capital, and he'll tell you more about his philosophy. And I suggest you take notes, play back the recording as well. When I invited Nick, I expected to do as much talking about the philosophy of trading as he will, but since I saw the presentation, I think I'll leave much of the talking to him, explaining. I will just be having a conversation with him. It's just like a casual conversation where I will ask the questions when it's necessary to help clarify his deep philosophy, to help explain it to the rest of us. And I say this not lightly. I say this with much pride, in fact, that I think the student has surpassed the master. Today, the master becomes the student. It's very interesting to hear what comes after. But here's Nicholas Cole. Please tell us more about how you use first principles to manage your portfolio.
Yes, thank you, V, for the very kind words. I think you're still the master in many ways. So actually, it's quite interesting because when you asked me to come to share about portfolio construction, which I do for my firm, Trident Cap, it's actually the first time I articulate or I had to put it down in a presentation, actually what I actually do that goes on in my head, right? So it's also quite cathartic in a way where it helps streamline my thought process. And so will be very happy to share how I approach portfolio management for the firm. So I think the first principles, that's where I always come back to in to declutter your mind, right? Because there are many ways to construct a portfolio, right? You have macro, market neutral, whatever. But I think the first principles helps clear a lot of things, clears your head. So first things is that the portfolio must be able to survive any market environment that is being thrown in it, right? So in that sense, the manager must be able to survive any market environment as well. I think that's also important, right? Not only must the portfolio be able to take the volatility and not go to zero, but the manager's mental capacity, capital, must not dwindle down also, right? Because once that happens, you do many drastic things that is inherently bad for your portfolio's compounding in the long run, right? Like, for example, selling your winners or your best positions in the doldrums, right? I think that itself has a huge effect on your portfolio's ability to compound. So I think protecting your mental capital is an extremely important thing that I actually consider when constructing a portfolio that can survive any market environment. And for everyone, it's different. I think you need to be very cognizant of your personal psychological makeup, right? Some people are more predisposed to anxiety and stress. Some people can take more of it. So I think it's not exact math, but you need to marry the art and science of constructing this portfolio. And the following is how I actually look at it. What are the key things I look for when constructing the portfolio? So I look for businesses or assets that have moat or moats, right? So for example, to elaborate a bit on it, so there are several moats that exist in the world of investing. So you have patent IP moat. So for example, in the biotech industry, you have companies with patent moat. So for example, Novo Nordisk, right? Many people know it as a GLP-1 company, right? The GLP-1 company, and that is always in rival with Eli Lilly. What I like very much about Novo Nordisk in terms of its patent IP is that it is in a very sticky industry in the biotech space. They mainly deal with endocrine health. They are the largest pharma company that is in endocrine health. So endocrine health deals with hormonal issues like thyroid, diabetes and all, right? They have the largest market share for insulin, and these are very, very sticky diseases, which it is not cyclical at all, right? So these are the kinds of company that we look for with very strong patent IP. Another mode that we consider as companies with very large network effects, right? Basically, you cannot survive or go about the world without them. So for example, Visa. Visa is not a banking institution, right? It is a financial rail. They build the financial rails for the world where they process transactions. So they have no credit risk and they are just taking fees all day, every day, right? Wherever you go, there is always Visa or MasterCard, right? So these are huge network effects that you cannot replace overnight. And the next one is the natural moat. So natural moat is a very interesting concept that I look out for. It is literally natural because there are companies that owns large parcels of land in the US or anywhere in the world. Land for thousands or hundreds of years has been a very natural inflation hedge against a monetary debasement. And if you can monetize the land, which I will explain more in a few slides later, that is a superpower, right? You have a natural inflation hedge plus a business on top of that huge land that you have. So this is one of why I highlighted it in bold, is because it's one of the my favorite modes that I look out for business, because it is extremely easy to value. There is no hidden nuances behind it that is very predominantly found in biotech companies or other tech companies, which they use a lot of jargons. Natural moat companies are extremely easy to understand. And the other one is the oligopolistic or monopolistic mode. As the name or term suggests, they are companies which they dominate the market by themselves or with two or three other people only, right? So that is huge pricing power. The last one, the last mode which I consider is the team mode, right? Basically, you're betting on a rock star team, right? Like a Real Madrid or Barcelona. Some companies do have that star power. One of the example is Constellation Software, run by Mark Leonard. If you look him up, he looks like Gandalf with a very long beard, a very eccentric fellow, but he's extremely sharp or very good in purchasing very sticky software companies, right? What you call vertically integrated software companies. So these are not your normal software that you see in the tech world that is accessible to us. So there are softwares like being used in air traffic control or accounting or ERP systems, right? Software that defense companies use. They are very sticky, deeply integrated into the system, and you cannot just switch the legacy system overnight, right? It's going to cost billions and billions of dollars, and you're going to need to retrain everyone. So his company scouts the world for such vertically integrated software and buys them up, right? So he has a very good team around them. If you look up Constellation Software, it is a company that almost never has a down day. So these are examples of modes that we look for to build the base or the core layer of our portfolio. Of course, valuation always matters. No matter how good a company, if you buy the wrong valuation, it's going to take a long time to fulfill its potential. Dilution matters, but if you are looking for very stable or mature or core companies, dilution should not be a huge issue because they are already at a stable state. But of course, we still need to look out if management does any too much dilution. Governance matters. So governance, it's interesting, right? So for example, in the biotech world, a lot of management teams will be pressured by investors and shareholders to capitalize their huge R&D spend, right? So if you spend billions and billions of dollars innovating a drug, how are you going to make your money back, right? So they are very predisposed to shareholder activism and huge pressure from the corporate world. So one thing that is very good about Novo Nordisk is that 50% of the shareholding is being held by the Novo Nordisk Foundation. So they are a generational business. They have no threat of outside shareholder pressure or activism, and they can focus and take the time to do what makes sense for the company. So these are very nuanced things that we need to consider when we select companies that form your base layer or the core layer of your portfolio. And obviously, most importantly, you don't want to invest in companies whose moat is shrinking or stagnant. You want to identify companies with a large moat, but that moat can be reinvested to make it bigger, right? So in a professional world, they call it return on incremental invested capital. Companies that can continuously reinvest in their moat to make it bigger and bigger. So that's what you call your flywheel of success. And of course, in the simplest terms, they are called compounders, right? So compounders is what we name these companies, and it is a cornerstone of which where we build our asymmetric opportunities on, right? So what I would term the portfolio that I manage for my firm is called the Compounders Enabled Growth Portfolio, right?
Yeah. So, sorry to interrupt there, Nick. I think it's an excellent summary of how you build a portfolio. And the moat, for those who read the philosophy of Warren Buffett, you'll find that he's very familiar, right? He always also buys the company with a moat. And for many people, like, what exactly is a moat, right? I think Nick articulates it very well. There's different kinds of moat, and different companies with different with dominance will have either one or more of these modes, right? So Nick is always on the lookout for that. And then here now he tells you how he builds the portfolio, how he forms the significant part of his portfolio. Yeah.
So this is how the portfolio is formed. So you have your core holdings. When I thought about it, the core and the mass core, they are actually interchangeable in a sense, right? So the core holdings for us now, it's being held in gold and Bitcoin for reasons which I'll explain later on in detail why I think that makes the most sense at this point. But the mass core, which is also companies that are very stable and companies that I really like, they can be part of the core holdings at a certain point in the business cycle, right? Or if you are a little more hardworking and you want to identify companies that have more growth, obviously you can find companies that fit into this category. So companies that fit into my mass core are companies like Texas Pacific Land, which I will explain more in a bit. Copart, they are a car salvage company. Well, I'll explain more in a bit. Visa, obviously you've heard of. FICO, very famous in the 2008, but they are ratings agency. They have huge moat in the ratings power and Constellation Software. And this is where the moonshots is, right? The moonshots, basically, they are our extremely asymmetric opportunity, which we built upon the our base layer, right? Our core and mass core. So if you recall, we talked about building a portfolio that suits your psychological makeup. So there is no exact science of how many percent should I allocate to the core, mass core, or moonshot, right? It really depends on your risk appetite, right? For me, I would recommend 70 to 80% in the core, mass core, and the remainder 20 to 30% in the moonshots, right? Of course, that's not set in stone, but you can calibrate it according to your risk profile. And I actually put a line there which says permeable. So it is by design to be permeable because the mass core can also move down to your core portfolio, right? Because they are companies that I really like, and they have proven management and earnings power that I don't really need to worry too much about them on a daily basis. And I structured this portfolio in such a way because it suits my psychological makeup in a sense where most of my time I'm interested in moonshot opportunities, right? I do not want to wake up every day thinking about the main bulk of my portfolio of what it's doing. So for me, I tend to read a lot on a daily basis, sifting through opportunities and managing the moonshot portfolio. Although the moonshot section, although it's a very small section, it actually takes most of your time, right? Because for moonshot companies, you need to track their progress much closely. And it's literally almost more of a full-time job, right? Tracking that small portion. So you do not want to waste your mental capital running about, right? Stressing and fretting over your other core business. You should just let it compound. And the moonshot is basically what I call the land of the 100 beggars. That is where I find it's very exciting to look at these companies. And in a way, it's also permeable. It's an incubation part of the portfolio, I would say, where once the companies prove itself over 3, 5, 6 years, they will slowly move down to the mass core and to the core, right? So there is a design and a method to this, to what we are doing. Yeah, hope I explained clearly on that for how we manage this part of the portfolio.
Yeah, I think Nick will now explain to you why gold and Bitcoin is the core. I think it's a very surprising thing for people to see how come Bitcoin is not like moonshot or it's not like some speculative bet, right? And it is not it's not because Bitcoin is now very established. Now it's become a reserve asset for countries that Nick is saying this. Nick has been saying this for quite a number of years. As long as I've known him, he's been a Bitcoin bull. And yes, at the beginning, of course, Bitcoin was a moonshot for him. And as time progressed, it became mass core. Mass core is basically short for mezzanine core, which is the layer above his core. And then it has now settled into this core part of the portfolio. He's also long gold, not just with stocks, I believe also physically as well. He's one of those conspiracy gold bug guys who goes buy a gold bug just to be sure he has his hands on his gold, right? So it's very, very interesting to see the progression of his views. Of course, for those of you who are new to us and new to seeing Nick for the first time, because he's left track record for more than 2 years now, Nick, right? You've been doing your own things, 2 or 3 years, I think 3 years, right? Since the start of COVID. Yeah, 3-4 years. So it is something that he's been consistently talking about. So now gold and Bitcoin is his core, but he will explain to you why it is the core and how he became so convinced of that trade. Yeah, please.
Yeah, so it's not a lazy asset allocation, right? Just say you buy gold and Bitcoin and just don't do anything, right? I mean, partly it's a lazy allocation, but it's because it makes the most sense for the effort put in, right? So it's my personal expression of why I think it's a core. It should be a core holding now based on the macro circumstance. I've always of the impression that the reserve asset will have to settle somewhere outside of sovereign level, which is U.S. Treasury, for example, U.S. debt, Japanese debt. But I think in recent months or ever since Trump took over, I think this has accelerated exponentially, and we are seeing a lot of signs that the reserve assets are actually moving from a sovereign level to a supranational level, right? So what that means is, in simple terms, is that countries are no longer keen on buying the U.S. debt or U.S. treasuries, right? And they rather settle their surplus or their reserves in gold or Bitcoin, right, for some fringe countries. And I think that is very telling of how bifurcated the world is becoming, how fractured geopolitically and globally we are becoming, that we do not trust the sovereign debt of governments anymore. And I think this is going to accelerate, or it has already been accelerating for China and a lot of other countries. They are choosing to settle in gold, Bitcoin, and companies are actually reinvesting or redirecting their investments towards actually commodities, right, hard commodities. And people ask, what does gold and Bitcoin compound? So to me, it compounds the errors in humanity's hubris, right? Complacency, recklessness, and stupidity, right? I think that has been very evident for hundreds and thousands of years. You've seen empires rise and fall. We always repeat the same thing. So that is what counts to me. And of course, at this point in time, I lose zero sleep as a call holding. I don't really need to care so much in a sense about it, because the trajectory to me is very, very clear where we are heading at this point in time, right? So to further elaborate on what I consider a neutral or supranational reserve, as I mentioned, gold and Bitcoin, in-demand commodities that fuels industrialization 2.0, right? I think a lot of countries are starting to reshore because as a result of breakdown of trust, obviously, we do not depend on other countries to come and defend us. So US is reshoring, China is reshoring, Europe is also going through a sort of industrialization boom. In-demand commodities, and commodities, basically why I call them a supranational or neutral asset reserve, because uranium, a pound of uranium is a pound of uranium, a pound of nickel is a pound of nickel, right? It's a globally wanted. It is not discriminated against, right? It is a necessity input for civilization. So to me, in-demand commodities are supranational reserve assets, and we are seeing companies and countries actually investing more heavily in stockpiles or investing directly into mines of country. For example, in Kazakhstan, where I'm quite active in, what I know is that a lot of Chinese companies are directly investing into Kazakh mines, gold mines, silver mines, and uranium deposits, right? I think that's where we're headed towards. Real estate, to me, it's neutral reserve. It's arguable because there's jurisdictional risk, like how London, UK, I think, confiscated Russian assets, Russian real estate assets. So I think it is arguable, but for now we would classify it as a neutral reserve. And I think real estate is a very pure way to look at the stage of currency debasement we're at, right? because it is understood by every single generation. So I think this chart very clearly shows, it's actually surprising when I first saw it, right, that although home builder sentiment in 2021 wasn't that good, but it is not very much so for housing prices, right? I don't know if you have seen house prices track or very closely mirror the Nasdaq, but it has since 2021. It has decoupled completely from rates and tracked the Nasdaq and like every hard asset, right? So housing has transformed from just an interest rate derivative play to a debasement play, right? I think a lot of people are hiding in housing assets, right? And it's very evident in the way it has behaved. And it's very rare to have seen housing move like a tech stock.
Yeah. So here, just to provide some clarity, the purple line is the Nasdaq. The blue line is the trust of home builders ETF, right? So it's a spider trust for ETFs of home builders. And while the one that's flatlining at the bottom is basically tracking the treasuries, right?
Yeah.
US bond treasuries. And I think most people, if you go back to your previous slides, Nick, the previous one, sorry, just to show, yeah, this one. I think many people will not be able to lose zero sleep while holding Bitcoin. I think it is just a matter of time frame and also the size that you're holding, right? For Nick, he's been involved since I say since what, $3,000 Bitcoin? Less, right? 1,000 something maybe.
2016, 2017.
Yeah, so it's been through all the cycles when 3,000 to 8,000, 8,000 to 3,000 to 10,000 to 30,000 to back to 10,000, right? And now it's like hundred something thousand. It's not just saying it, right? He did not sell a single Bitcoin that he didn't need to pay for bills or to buy some food, right? So to buy necessities for his changing life. But this is how you should form your portfolio. Of course, you can find your own core layer of things that you depend on. You don't need to have a huge allocation to while highly volatile assets, right? For Nick, for him, the volatility is now a fraction of what it used to be to relative to where he got in. So he's okay with that. So it has become from a moonshot. It has become the core layer of his portfolio. So whichever level you begin, the philosophy of track record is not to just give you the fish, right? We don't tell you, okay, if you go buy this stock and then you make money. I mean, we try to do that by sharing our views of what we are doing, but also we are sharing the principles and the philosophy of what we do so that you, with your own expertise and personal experience in the various industries that you are well versed in, you can find your own core layer, core holding where you're very comfortable, you understand the ins and outs of the whole industry. So that's the part where I want to explain, because it's not like we are saying to you, just go out and buy a bunch of Bitcoin because you're not going to lose sleep over it. I think if you're just getting involved in Bitcoin, you will lose sleep over it. It didn't move from 120,000 to 110,000 in 2-3 hours or something like that, right? Okay, please continue, Nick.
Yes, thank you for clarifying. That's a very good point, actually. Yeah. So to put more context to it, home prices, which is in the blue line, US Schiller Home Price Index, they have done very well since 2002. But interestingly, against gold, home prices is actually down 70% in gold terms, right? So obviously what you're seeing is what you may call it the Cantillon effect, or those assets closest to the increase or more sensitive to the increase in money supply tends to react more, right? It used to be gold, but I think now Bitcoin is more reactive to the increase in money supply, right? And of course, in the last chart, if we add BTC, what you see is home prices since 2016 is up about 100%, 90%. Against gold is down 40%, but against Bitcoin it is down almost 99%. So yeah, so it's a feature of a bug, right? The volatility and the finite supply.
So, yeah, of course, we are not saying now go sell your house and buy Bitcoin, right? This is late cycle,
Yeah,
mid-cycle Bitcoin is no more the moonshot, right? It's supposed to
yeah,
be,
the core
but
asset. Yeah.
yeah, but it's a good point, right? Like that you know, if the reason why we see a lot of asset appreciation in the last 10, 20, 30 years, uh, or as if you measure the stock index, it goes up over the longer term, house prices goes up over the longer term, gold and now Bitcoin. It's all because of money printing, right? The governments continue to spend. It's a flaw of democracy and finite terms of politicians where they have no downside, they have no repercussions of spending everything they can this term in hopes of getting re-elected the next term. And then in the next term, they're not going to be re-elected again. So who cares what they do, right? They just do whatever the hell they want to benefit their friends. And so it comes back to the point where for some of you maybe a bit confusing because Nick says the compounding of his core layer is that it is compounding on the idiocy, the stupidity, the profligacy, incompetence. What's the other word you use? Recklessness. What else?
Recklessness, stupidity, and I forgot the other one.
Yeah, but it's actually all the bad things about humanity. Basically, not all humans, but basically the humans in charge, which are politicians. So it means that essentially most political promises are all about spending a lot of money to benefit a small group of people or a large group of people to gain votes, and that has been happening through time, regardless of whatever it is. It's always been the case. So you are just betting when you have this core layer of gold and Bitcoin. It is not good. It's not something. It's not a rocket science. It's just like betting with the trend that has been going on for years and years. In that governments will continue to spend as long as they can spend, and they don't have to pay in their lifetimes, right? So just keep on spending, and that's why we see assets going up through the ages, through years, through time, and basically in everything that you see, right? But the food that I eat, a dish of fried noodles in Malaysia, where I grew up, used to be like 50 cents US dollars. It's now maybe like $4 US, right? So everything goes up, right? It's just like that. And what you see here, why Bitcoin is outperforming so much, is also because it is gaining the network effect, a lot of other things, but it's also the truly finite something that's truly finite, right? There's only this amount of Bitcoin, and as more people get involved, more Bitcoins are being lost to also human stupidity, where they don't know how to retrieve it anymore because they've forgotten the passwords. You read about it in the press. So the supply, in actual fact, while of course is mining, the supply is increasing, but from the beginning, it's coded in an algorithm that it's going to be this amount, 21 million, right? 21 million coins. And in fact, as time passes, this 21 million begins to get lost more and more because it falls into humans' hands, and then they forget, they don't know where it is, they don't know how to retrieve it anymore. And this is going to continue through time. We're going to have less and less Bitcoin, but more and more people involved. And as such, you probably have lost the chance to buy Bitcoin at $10,000 for the rest of forever, unless something drastic happens, right? Like quantum computing or whatever. But that's another presentation on another day. But please continue, Nick.
Yes, thank you for explaining. Yeah, and so the core is of course predicated on hard data, but I mean based on performance that you see, but also I think we are seeing signs of the day of reckoning is here, right? Is approaching, and that makes it exciting for me because in that sense, the core holding is not just going to see a linear increase, but I think when that happens, or when such things like a gold revaluation or whatever happens, it can also be an asymmetric change, right? A step change in how gold is being priced or how Bitcoin is being priced. So what's interesting is just this month, it's August this month, the Fed or the politicians are already contemplating, right, revaluing their gold holdings, which was valued, if you can see the first paragraph, the last sentence, it was valued at $44.22. 42.22 dollars per troy ounce, right? I think that's what happened, or that was the value that was being struck during the Bretton Woods year and 1971, and it has not been revalued or it has not been changed since. And what the Fed and the Treasury or the government is considering is revaluing gold to current mark-to-market rate of about $3,300 per troy ounce. Imagine how much fiscal or how much money they will suddenly unlock in their coffers, right, or on the Federal Reserve or Treasury's balance sheet overnight. And this is not something that is new. Other countries have done it before to their success. Germany, Italy, Lebanon, Curacao, Saint Martin, and South Africa has done it before. And it's a real conversation that the Fed or the Treasury is having. And with Trump in office, I think it's more than likely that if this were to ever come true during his term, right? So that is very interesting, because if that happens, then I think it's going to be a step change where gold prices may suddenly revalue overnight, right? So this is something that we are looking out for. And I think it's becoming more necessary in a sense. The US deficit condition or situation is getting bad, where inflation is coming back on a lag. And in that sense, even if Powell or the new Fed, whoever we know, were to cut rates, what I think in the world where inflation is rampant is that it will be faded back to a neutral rate, right, where it will track inflation. But if the Fed were to do this, it is a form of yield curve control where you release a huge amount of money into the economy, and rates will not revert back to the neutral rate of inflation, right? And I think this is a very important political tailwind that Trump needs. And as I said again, if this official reserve revaluation were to happen, I think it's going to happen during his term. And this is something we are looking out for. So it is very apparent that whatever we have been speculating, so to speak, for the past few years, that currency debasement, fiscal profligacy is going rampant or way out of hand, it is actually happening, right? And you are seeing cracks at the seams, right, with this kind of papers or OPED being released to the public to shape or to sort of form a soft narrative first in the public perception before going with a proper policy. So that is on the gold front. What is exciting on the Bitcoin front is the Genius Act, which I think many people just celebrate that, oh, okay, Bitcoin is having a framework and everything. Yes, it is, but I think there is a deeper connotation to this Genius Act than just random framework that shows that probably US is at the forefront of this, right? The Genius Act, I believe, is a last ditch or one of the very strong efforts that the US government is trying to save the US Treasury market or the US dollar hegemony. As we mentioned before, that a lot of countries are moving from sovereign to supranational. What that means is that a lot of countries like China, Japan, which used to sterilize or buy a lot of US debt, are no longer settling their surplus in US debt, but settling in gold and other hard commodities. So who is going to step in to buy this US debt, right? So surprisingly, Tether, USDT, if you are familiar with. So Tether is a US stablecoin company. It is actually one of the largest private holders of US Treasury debt, right? And I think this Genius Act actually formalizes this framework where it allows US banks and US stablecoin issuers to use Treasury debt to back their stablecoin. What that means is that you do not need to back a stablecoin with USD itself, but you can back it with US Treasury debt. That means in a world where you or I buy a USDT, or any stable coin for that matter, we are de facto are unknowingly backing or sterilizing US deficits for the government, right? And I think that it is, to give it to Trump or whatever, his thing is quite a brilliant move. And in that sense, his or the US goal moving forward at this point is rather much aligned with BTC market cap, right, or the crypto space, because as BTC market cap increases, what that means is the stablecoin market cap will also increase as a derivative of it, right? Because BTC stablecoins, they are very interoperable. Like for myself, when I sell BTC, I will go into stablecoins and vice versa. So these two instruments are tied to the hip. And what that means is that the larger the BTC market cap, that means there's more demand for US treasuries as a default or de facto condition, right? And this is the chart to show what I meant just now. Tether, at this point, is one of the largest holders of US Treasury debt, right? And what I believe the Trump administration or the US administration is pushing for is for the stablecoin market to take the place of the sovereigns moving to supranational, and to come in as the buyer of last resort, as one of the important buyers of last resort for to sterilize US debt.
Yes, so I think, okay, we need to also clarify a little bit, right? For those maybe a little bit confused about what Nick means when he says reserve assets are now going supranational instead of sovereign. It used to be people are very comfortable as Japan, China, as they grew their surplus, their national savings are all accruing in, all saved in US Treasuries, right? They bought US Treasuries because it's the most liquid asset markets in the world. They care more for transparency, for liquidity, and the size of the market for them to be able to hold so much and not be subject to having trouble where you are the biggest holder of one asset, right? So it's big enough for them to do this, but that has changed because when Russia went to war with Ukraine, US froze Russian central bank assets. Governments that's allied, they are allies of US, confiscated private wealth of Russian individuals claimed to be connected to the government. So this change, right, as you can see on this chart, China was the biggest holder of treasuries at one point. They have been slowly selling it down. They have become second now to Japan. Japan used to be bigger than China. China then outgrew, and then now it's below again. And you can see the trajectory is probably going to go below the holdings of the UK. And the growth comes in Tether stablecoin. I think, as Nick says, it's a genius move, genius act and a genius move. That USDT is a private company, which was at one point, many instances through the years, especially in the bear markets of cryptocurrencies, people thought that it's a bankrupted company, but somehow they managed to survive, and now it's one of the most profitable companies that do nothing but issue USDT, right? So that's like the best game ever. You basically print money from air, from just algorithm, and then people give you their US dollars. They use the US dollars to buy US treasuries, so they get a yield on it. So they will eventually become one of the biggest holders of US treasuries in the world. And it's also, I believe that's why Trump is very active in trying to not he basically issued an act where promised that the US government will not issue their own US stablecoin, right? Because I think he wants these companies to persist throughout the world where they will have buyers of US debt, right? And that's great for the US. They can keep borrowing. And why it has to go from sovereign to supranational, meaning that it is not subject to sovereign risk, not subject to any government's wish or whims, is because you're okay with holding US Treasury debt at $100 billion, at 300, maybe at 500, at 1 trillion, you start to be afraid, right? Because they can confiscate it anytime they like. They just need to find an excuse. And as we have seen, I think in the years before Trump, it seems like they were operating by a set of rules that everybody knows, right? It's a set of kind of like a Geneva Convention for financial rules, right? Where you don't do things that doesn't make sense. You don't. So, but that has been completely overturned and overridden by the Trump era of just do whatever he wants to do, right? He can nationalize Intel, take a 10% stake in Intel. He can tax chip exports 15%. Any chip you sell to China, we tax you 15%. Basically, this is quite arbitrary. It's not it's unprecedented in the sense that people don't expect it to happen in the US. It's more like something that China would do. Take a stake in a nationally strategic company, right? Take a stake and then you give them grants, you give them advantages, you tax their competitors, things like that, right? So it's kind of like that now. That's why we need to, countries are worried, especially countries that don't get along well with US or tries to get along, but US doesn't want to get along, find them as a threat to national security or whatever. So anyway, please continue next. Sorry.
Yeah, no, so it's it's a good expansion. So I hope it sort of clarify that the gold and Bitcoin is not just a lazy allocation, but actually thought through it, the implications, right? So I think in a sense, yes, the core is it's stable and linear, but obviously you can see that there are a lot of pathways where it can be extremely asymmetric as well, right? The genius egg and the revaluation. So having said that, so that is the reason why a large portion now of our portfolio is allocated to these core holdings. Of course, we do have mezzanine holdings as well, which I will talk about and give two examples in the following slide. And also I think that they are trading at reasonable valuations at this point in time. So they are exciting for me as well, right? So mezzanine, so stability, I think people mistake it for having very low or subpar returns, right? But I don't think that is actually the case if you actually look at it deeper, right? Texas Pacific Land, as mentioned at the start, they are sort of one question is why they can own so much land, right? Is because they've been around since the 19th century. They've been operating in the 1800s. So I think by luck or some I'm not so sure, but they have 800,000 acres of land. That is about 4 times the size of Singapore. And they have land in the most prolific shale basin in the world, right, in the Permian, where actually if the Permian Basin were to be a country, it would produce more oil than Saudi Arabia. So that's the amount of land they actually have in the US. Right, as mentioned before, land is a natural inflation hedge, and land with oil is a very, very good inflation hedge, right? And on top of that, what they do is they lease out their land. Okay, so I'll explain later the business model, but I think that the main thing here is to show that a land company with oil significantly outcrushed the Nasdaq performance since 10 years ago, right? So I use 10 years as a very easy benchmark to compare. But if you go back further in time, their outperformance versus the Nasdaq is way more. All right, so this is one example. Yeah, so to explain more about what Texas Pacific Land does, they are a pure real estate company. They own large parts of the Permian, but they do not do any of the high-risk oil exploration or drilling, right? So what they do is a very, very smart move. They tie up with companies like Chevron, ExxonMobil, Shell. They lease parts of the land to them to drill and explore for oil, and they take royalties from the oil sales, right? So it's a very, very capital light model, right? So it doesn't really matter if oil prices goes up or goes down. Obviously, it goes up is better because they collect more royalty, but they would not be very much affected as your normal oil explorers or producer companies, where oil prices go down, it goes below the break even and they suffer, right? I think that is the magic of Texas Pacific Land Core. If you look at the bottom right, they do not just make money from the oil royalties, they make money from every layer of the land, from the surface rights. That means if you have a truck or a car or whatever on the on top of this, on top of the land. You have to pay them a rent because you're using space on the land. The water beneath the land, they also take royalty fees for using that water. And they just do very simple ancillary services like after using the water, it gets dirty, they filter it and then they clean it and dispose the water. They charge even more fees on that, on top of that, and that is like basically almost 100% margin because it's very simple services that they add on. So through these capital-like execution and very simple model, this is actually from their main company investment presentation. On the left, you see since 2017, they have significantly out-compounded the Nasdaq and basically every other oil company, which is way below, right? So these are the companies that we like in the mass core of, as I said, is permeable to the core because I would not lose sleep over holding Texas-specific land. Their business is extremely understandable. You won't have any surprise, and the land mode just compounds in value over time. Right. So the next example is Copart. So Copart is a hybrid between natural and oligopolistic. So again, 10 years comparison against the Nasdaq. Car salvage company significantly outperforms the Nasdaq, right? And if again, if you go further back in time, the outperformance is even more. But for ease of comparison, we just go back 10 years. So Copart is in the oligopolistic market because their only competitor in the US is IAA. So as a salvage company, what's interesting is since the very early days of Copart, the owner of the company is a very paranoid individual. He only wants to own land, he doesn't want to lease. So if you look at the bottom comparison, you can see the competitor, 12,000 acres, but almost everything is leased. Whereas for Copart, they own 19,500 acres, which is a lot of land for a private company that has nothing to do with land. They own 90% of it, right? That is a natural inflation hedge. The land, if you value it to today's market, so just like the Fed, when gold was valued at $42.22, Copart's land has not been revalued since the 60s or 70s. But if we were to, I believe the balance sheet will be a lot more valuable. But that is not the main business of the company. The main business of the company is they are a very capital light car salvage and auction platform. Basically, whenever there is a road accident or there's a car accident in the US, the cars will most likely go to Copart or IA, and they will flip the car for salvage value. And the Copart system, they're also a software system, is so accurate in valuing the value of the salvage or the scrap value that they are the gold standard for insurance companies to work directly with, right? So there is not only a land mode, but there's a software mode, there is a pricing mode. Copart is almost irreplaceable in the US in terms of this business. And they are also, interestingly, an inadvertent beneficiary of advancements in autonomous driving and advancements in automobile. Because new cars, they use a lot of chips, like NVIDIA chips, AMD chips, or whatever chips inside. So whenever cars get into accident, more likely than not these days, it is too expensive to repair. So they will just deem it irreparable, and that's where Copart comes in, right? And you can imagine with all these new rare earths and chips in the car, the salvage value gets more expensive, the fees gets higher. So Copart is also benefiting from the tailwind, whether they planned it or not, from advancements in tech, automobile, and chips. Right, so these are the kind of companies that I do not lose sleep over because it's very predictable. Their mode is very inherent, and they are part of our mezzanine core portfolio, which again, as I said, is permeable with the core. At different cycles, maybe these will have a larger holding as compared to gold and whatever other companies, right? So the reason I showed these two is because I think they are at very decent valuations at today. And if I were to start constructing a portfolio from scratch, I would definitely include Copart and Texas Pacific Land at today's multiples. Yeah, that's all from me today. I don't think we have time to go into the moonshots. Probably we'll do it the next session.
Yes, the moonshots will be the next webinar, the next members webinar. Of course, it's more than enough for one session today to try to get your head around the core layer, the compounders. But it's important to understand that the compounders means that you buy something that will make you money over time, and then it compounds on it over time. And then because they have a mode that compounds, that they compound many different aspects of your investments, right? So and the non-dilution part is very important. I think that's very that's not as well advertised. You don't want to be diluted while you hold the thing and time passes. In fact, you want to be concentrated, not diluted, meaning that, for example, some of these companies, they actually buy back their own stocks. So as you hold, as you go through time, you get more and more of the ownership, right? So to give you a basic, a simple, understanding of what the next presentation, the next webinar, the moonshots is all about, is about limited downsides, having limited downside versus multiple X upside asymmetric returns, and then beginning with the end in mind, knowing how big the company can be, what is the potential of the company. You don't buy something that can only be a small fish in a big pond, right? You want to have a company that is a fish that can go to the sea and become a big giant fish there, right? So we will talk about that, and then always searching for the next big thing. Here, the quote that Nick uses, invert, always invert, is basically what he says, begin with the end in mind, keep on thinking what are the possibilities if you continue on this path, right? So with that, I think we will conclude our presentation, with our guest starring Nick webinar. And thank you for your questions. I hope we answered all of them. But for those who still have questions, feel free to drop us an email. And the next webinar will be the land of the 100 beggars. We will announce a date when we will share with you our thoughts as well. We are reactivating this series of members webinar, because I think it's really interesting now. Markets have become really interesting. There's a lot of things happening, AI and other stuff, but the much advertised themes, everybody thinks it's just about AI and tech, but actually there's a lot of things happening as well. So let's have more discussions like this. Send us questions even if in your everyday life you find something very interesting, drop us a note. We can discuss about it in time to come. As always, thank you for being part of our journey, and stay true to the process. And Nick has demonstrated he's not only through the process, his investment process adheres to the principles of the track record trading framework, but he's also enhanced on some aspects of it, and he's articulated even better than I did to him in all those years ago. Thank you very much for being part of this tonight. Thank you, and we'll see you again soon. Thanks, Nick, for being part of this as well. Thank you for sharing your thoughts. Good night and good luck. Bye-bye.
Thank you. Bye-bye.